Most business owners know a 401k match is a benefit, but very few understand how to squeeze real value out of it. If you do it right, a 401k match can lower your taxes, improve retention, help your cash flow, and build your own retirement faster than relying on investments alone. In this video, learn how to maximize 401k match for your business, finance, and save more money. First, understand what a 401k match really is. A 401k employer match is simply you, as the business owner, contributing extra money to an employee's retirement account when they contribute as well. Think of it as shared saving. The government allows this system because it reduces dependency on public programs later in life. Now, let us simplify the math. If an employee earns $50,000 per year and contributes 4% of salary, that is $2,000 annually. If your matching formula is match up to 4%, you also contribute $2,000. The key point here is that your contribution is considered a business expense and is tax deductible. Many owners think this benefit only helps employees. In reality, it can help you personally if you are also on payroll and contribute as an employee. That means you gain retirement savings and tax savings at the same time. For small business owners, the most common setups are traditional 401k and Safe Harbor 401k. Safe Harbor removes most compliance testing and is often the simplest path for small teams. Understanding these basics helps you build confidence before jumping into optimization. Without this foundation, owners feel confused and avoid retirement plans altogether. The truth is, once you know the basic math, it becomes much easier to manage. Use matching to reduce taxes and improve cash flow. Most business owners underestimate the tax advantages. Employer match contributions reduce taxable business income. For example, imagine your business earns $1 million in revenue. After all expenses, your net profit is $200,000. If you match retirement contributions for yourself and your team worth $30,000, that amount reduces your taxable income from $200,000 to $170,000. If your combined federal and state tax rate is around 30%, you save roughly $9,000 in taxes. That is real money that stays inside your business. Cash flow concerns are also common. Here is where planning helps. Instead of thinking about the match as a single annual expense, spread it across payroll cycles. If you run payroll 24 times per year, divide the annual match by 24. That makes cash flow smoother and predictable. Larger companies already do this, but small business owners rarely think this way. Also, remember, employees contribute from their paycheck, which means you only match when they contribute. This prevents overcommitting. Strategic matching plus tax savings means you are not just giving free money, you are improving your after-tax profit. This is why accountants and financial planners consider 401k matching a core business finance tool rather than just a perk. Use matching to attract and retain talent. The biggest hidden cost in running a business is employee turnover. According to multiple HR studies, replacing a single employee can cost between 30% to 70% of their annual salary. So if someone earning $60,000 leaves, you may lose $18,000 to $42,000 through lost productivity, training, and onboarding. A strong 401k match is one of the simplest ways to reduce turnover without constantly increasing base salaries. Here is a practical example. Let us say your employee contributes 4% and you match 4%. That combined 8% retirement saving feels meaningful to a serious professional. If that same employee gets a $12,000 raise offer somewhere else but with no match, they might stay because they value long-term benefits. This keeps your staffing stable and your long-term training investment protected. It also makes hiring easier because professionals understand retirement benefits better than random perks. Think about how large companies attract talent. They almost always have a retirement plan with matching. Small and mid-sized companies can use the same strategy, especially in competitive fields. From a business finance perspective, paying a few $1,000s in match is cheaper than losing employees and spending tens of thousands replacing them. Owner strategy to maximize personal savings. One thing most owners do not realize is that they can participate in the plan as employees if they run payroll for themselves. That means you can contribute pre-tax and receive a match from your own company. This creates a double benefit: tax reduction now and tax-deferred growth for the future. For example, an owner earning $120,000 on payroll can contribute up to employee deferral limits and then match that contribution as the employer. The match is deductible for the business and grows tax-deferred for the owner. For even higher contributions, add profit sharing. Profit sharing allows the company to contribute additional amounts on top of the match, giving owners more flexibility. With profit sharing, owners can sometimes push total contributions to levels above $60,000, depending on age and IRS limits. This level of contribution is powerful for older business owners who want to catch up quickly. It is important to work with a retirement plan administrator or CPA to set the correct plan type. Safe harbor plans are common because they allow large owner contributions without failing compliance tests. The combination of employee deferral, employer match, and profit sharing is one of the most overlooked advanced strategies in business finance. Key structures and formulas that protect margins. Not all matches cost the same. The formula you choose affects participation, cost, and savings. The simplest matching structure is dollar for dollar up to X%. A common structure is dollar for dollar up to 4%. Another structure is 50 cents on the dollar up to 6%. Both result in similar percent rating. Maximum cost, but incentivize different behaviors. You can also use vesting schedules. A vesting schedule delays full ownership of the match until employees have stayed for a certain number of years. For example, a 3-year vesting schedule means an employee who leaves after 1 year only takes a portion of the match. This protects your benefit budget and improves retention. From a business finance perspective, the right formula keeps your benefit cost predictable. A mistake many owners make is offering a match without modeling the financial impact. Before finalizing a plan, estimate participation rate. If you have 10 employees and expect 7 to participate, model the cost for those 7. Then factor tax savings. After that, compare the cost of matching to the cost of losing employees. In most skilled industries, matching turns out cheaper. If you want maximum simplicity, safe harbor plans remove compliance reporting stress and satisfy IRS requirements automatically. The right structure protects margins and retention at the same time.